Good morning. Welcome to this year's third investment town hall. I hope everybody is enjoying the reopening of the economy and finally getting out to see their friends and family this summer. So much has changed since our last meeting, though. A lot of us have been vaccinated and we're cautiously and slowly returning to the office. For those of you who've attended the previous webinars this year, you may remember that I'm Deborah Feldman, Managing Director and Wealth Manager of the Leonetti team out of Chicago. It's sure good to see you again. And for those of you who are watching their first town hall, we welcome you. This is actually the second town hall that I've hosted since we merged our firm with Fairport, and we're very excited today to welcome our clients in Cleveland and Chicago to this event. Based on your feedback, we're scheduling these webinars on a quarterly basis, and Emily Drake and I will take turns moderating. However, if you may have questions about the markets and are wondering what our opinion is and what's going on. So please let your advisor know a little in advance of these meetings so our Chief Investment Officer, John Silvis, and his team have time to prepare slides to explain their position. We've designed this meeting for you, and the goal of the town hall is to connect you directly with John. He'll recap where we've been, describe where we are today, and share his thoughts on what lies ahead. Having said that, though, you really don't need to wait until the next town hall to get an idea of what we're seeing in the market. You can always contact your advisor for an update, or you can receive timely Fairport perspective updates via email, or you can subscribe to the Fairport Flash podcast on Apple Podcasts, Stitcher, Google Play, or finally, you can follow the hashtag Investing with Fairport on LinkedIn for weekly thoughts on the markets and economy. Since we're going to be talking today about stocks, bonds, and investing, before we begin, we want to make you aware of a serious announcement received from one of our custodians. Charles Schwab has a bulletin posted about vishing. You heard it right, vishing with a V. Vishing is phishing, but via the telephone. Schwab's notice reads as follows. We've received reports that scam callers have been impersonating Schwab by phone and requesting non-public client information, including social security numbers. In these calls, the caller ID displays the name Charles Schwab and a Denver area code. If you receive suspicious calls posing as Schwab or any other trusted party, like Social Security, hang up immediately and then call Schwab or the other organization on their listed phone number to discuss the situation as soon as possible. As a final thought on this and a best practice, we'd like to leave you with this information. Be mindful that these attacks occur often and be suspicious of any unexpected requests for sensitive information over the phone. Please take time to think through the situation before reacting. Don't let anyone pressure you into giving information you're uncomfortable providing. Under no circumstances, give out your social security number, bank account number, or any personally identifiable information over the phone unless you're the one who initiated the call. And finally, remember that companies, including Schwab, generally do not call you to request your personal information. A little bit about housekeeping now. Everyone's going to be muted for this webinar and your cameras are disabled. If you have questions that arise, you can type them into the questions section of your toolbar and we'll answer as many as we can, time permitting. So without further ado, I will turn the microphone over to John.
Thanks, Deb. Appreciate it. I'm going to share my screen here. That's let me know if you can see it. Can you see it now, Deb?
Yes.
Okay, great. So, all right. So we already accomplished the first thing. We got the tech to work. So, yeah. So I'm going to go over, the first half, really second quarter, but the first half of the year. Kind of go through the process, what we saw, as Debbie mentioned. Really, and you hit on all three of these, Deb. If there's been a theme this first half of the year, it's been vaccinations, reopening, as you mentioned, and just getting out of town and getting out and about. So, one of the problems we talked about a shortage of ketchup at one point, toilet paper. Now it's really gasoline. So we've seen some shortages here and there. But I think as this cartoon can attest to, people just want to get out of the house. I actually got gas this morning. It was $3 in Strongsville, Ohio. So not quite as high as the what we're seeing here. But again, I think You know, just to kind of put it in perspective, I've been to 2 baseball games, I've been to a wedding, I've been to several graduation parties, and I actually went to the movie theater. So I can attest that I think people just are stir crazy and want to get out of the house. So hopefully that's all going to filter into the economy. So I thought we start with just the reopening instead of going right into the equity markets, because I do think that's what's been driving things. This is the daily case numbers you'll see. We get this from the website called World Meters, and anybody wants to go out and look at the website, you're free to do it. It's a free website. But as you can see, I'm going to try to use my cursor here. As you can see on the right-hand side of that chart, you know, we're back to levels that we saw back in March and April of last year. So right about the beginning of the pandemic. So the cases have come down quite a bit. I know there's been some issues recently with the Delta variant out there, and it's, you know, something we're keeping a close eye on. But I think the big picture fatalities have come down quite a bit. Most of the fatalities are those people that have been unvaccinated. So I think, you know, I'd strongly encourage everybody to get vaccinated if they haven't, and they kind of put that into perspective in a larger picture. About 55%, or, you know, over half of the population have had at least one dose of the vaccine. We're getting close to that 50% which is fully vaccinated. So, you know, again, we're getting close to that herd immunity. Probably we'll see that in the not too distant future. So if you know anybody out there that hasn't been vaccinated, I would strongly encourage you to do that. Second part of the reopening is travel. You know, people are on the move, as I mentioned earlier. Everybody I know has either been on vacation or heading on vacation. I think people just wanted to get out of the house, see a change of scenery. So this is the Tsa Travel Numbers. Those are people that cross through TSA on any given day, TSA checkpoints. And this is right before the July 4th weekend, so the numbers are actually a little higher. We're at 2.2 million people going through. So again, people are out spending money, moving about, which, you know, all filters back into the economy at some point. So, you know, in my opinion, I think it's hard to see with how we go back at this point. You never say never, and obviously there's some unknown things out there with different variants of COVID. But I think this chart shows it all. Just 6 states are less than 90% open. You know, if you've been watching TV, the NBA finals are full. The NHL finals had full attendance. So you see these packed arenas out there. For you Big Ten football fans, I know that almost all the schools have announced that they're going to have full capacity in the fall. So that's over 100,000 people in an Ohio Stadium. Penn State fans, so Beaver Stadium's going to have 110,000 people, so on and so forth. So obviously watching how this new variant and/or variants progress, but I think overall, I think, you know, we've hopefully, knock on wood, turned the corner there. So kind of switch to the equity markets, which is probably the more important thing. But I think as the economy grows, as we've said many times, you know, that tends to flow into the equity markets. So as you can see from that third column from the right, the year-to-date numbers, this is through the second quarter. So as of June 30th, real estate investment trusts have actually done the best. They're up over 20%. You go 2 or 3 down, that orange color is small caps, which are, you know, just under 18%, and then large caps coming in at 15.3. We've actually built off of that since the close of the quarter only a few days ago. I know this morning the S&P opened at a high, so that's the 39th high. Well, if we close at that high, it'd be the 39th time we close at a high this year. So again, that's about 1 out of every 4 trading days. And I think right now the S&P is up about 17.7% going into the day. Bigger picture, over the last year, ending June 30th, so June 30th of 2020 through 2021, the S&P was up 40.8%, about 41%. The MSCI ACWI, which is an all-country world index, it's a global index in nature that we tend to use frequently here at Fairport, was up about 39%, so pretty much right in line. And the Russell 2000, which is a small cap index, was up 62%. So, you know, we're seeing we're grandfathering in some pretty good returns in the markets, and we'll talk about staying invested near the end here. But the other thing I'd point out is fixed income has really struggled year to date. It's down about 1.8%, actually 1.6%, sorry. And you know, rates have been kind of stagnant around that 135, 140 level, and you know, we'll talk a little bit about rates as we go forward. So, the thing I get asked a lot is, well, people are nervous about the markets, are nervous that they've gone up, but there's always a wall worry to climb, as they say, within equity markets. So, corrections are to be expected. We're probably likely overdue. To put too much time and thought into it is probably not necessary. I think, the fundamentals of the market are pretty strong. We're actually at the second longest streak in the last 10 years. We are over 150 days without a correction of 5% or more. So put into perspective, you see 2 or 3, actually 3 or 4, 5% corrections a year on average, sometimes more, sometimes less. We haven't seen one. I would expect over the next few months or quarters, we're going to see that happen. It's not something that we're too concerned about. And again, I think from a fundamental standpoint, it's kind of natural in the equity markets. So I'll pause there. That's just kind of a recap of the second quarter or the first half. Deb, if you have any questions, or if there's any questions from the listeners.
Actually, I do. Everyone knows now that interest rates, CDs, bonds, savings accounts are super low. But REITs, like you mentioned REITs before, and they're paying really attractive dividends. Would we consider a larger allocation to REITs to increase the yield as part of the fixed income portfolio strategy?
Yeah, so that's it's a timely question, because as you mentioned, they've been one of the best performers, or the best performer the first half of the year. And I'll get into our large cap portfolio and where we have our overweights and underweights. So we have a slight underweight to the real estate investment sector of the S&P. It's something we've been looking at. We've actually increased it a little bit, but we went from a underweight to a slight underweight. I would not be surprised if we move that up to at least a market weight, or maybe even a little bit above that as we go forward. One of the reasons why REITs have done better than expected, and I think for most people going into this year, REITs were probably not a sector or asset class that you thought would outperform, is because rates have come off that one. So we were up to 175 on the 10-year, 180 on the 10-year, and we've seen that actually come down, and that's kind of when REITs have outperformed. I think if interest rates, start to go back up here, and I think our overall view is they'll probably grind higher into the year end. That might not be the best backdrop for the real estate investment trust. So we're kind of keeping an eye on that. I'll have more to say as we get into the second half of the year, and I think most of that's going to be data dependent on where we think rates are heading. The Fed chairman speaking today, I believe, in front of the House and Senate, or one of the two. And so, we'll see some more movement as we go forward.
Thank you. That's all I have for now.
All right. So we talked about, the first half of the year a little bit. As we've laid out over the last few times, our belief is, the economy tends to drive earnings, and earnings tend to drive the market. So we like to, go back to the economy, check in. A lot of the slides we're going to use over the next couple minutes are ones you've seen before. I like to say there's a fine line between being redundant and being consistent, and I hope I'm more consistent than redundant. But I think, these are ones that we watch on a close basis. We talked about them probably a year ago, back in April or May, as what areas we thought would be good indicators where the markets are going, and or where the economy is going, therefore the markets. So the first one here in front of us is the Atlanta Federal Reserve's GDP Now estimate, and I've used this many times in the past. It's one of the best econometric models out there, and we just completed the second quarter, I guess about a week ago, and right now it's anticipating about a 7 or 8% GDP growth on an annualized basis. First quarter was about 6%. It seems like this second quarter did grow a little faster than the first, so we'll see. We'll get final numbers in about a week. Or I'm sorry, about a month, sometime at the end of July. So a couple of weeks from now. But best estimates, it's probably grew over 6% and probably trending closer to 7 or 8%, which is good. Employment picture, again, it continues to improve. I'll try to use my cursor here as we go. We had this big spike up a year ago with people claiming unemployment. It's kind of come down here, but again, we're leveling off. Some of that has to do with the extension of unemployment claims, and we'll talk a little bit about that. As probably maybe something that's holding back the labor markets a little bit. I'm sure everybody's walked into a convenience store or a restaurant and they're short on staff. Some of that's probably because of the extension of the unemployment claims, but that's slowly starting to come off. So, but overall, the employment picture looks really good. the unemployment rate is below 6%. A lot of people were predicting a year ago it would take us years to get below 6%, and we did it within about a year. So definitely stronger than people anticipated. That V-shaped recovery definitely took hold. Company surveys, again, this is a real-time indicator we use to give us a gauge on where the economy is and what the sentiment of corporations are out there. And that V-shape recovery looked pretty similar to this. There's been some pullbacks along the way, but again, we're at 20-year highs, well past where they were pre-pandemic. So other than shortages out there and labor issues, most companies are pretty positive. I think there was issues with lumber prices earlier. Copper prices have started to come down, so I've heard there's a shortage on rubber now. So I think we're going to see those, but I think overall, especially in the retail side of things, corporations, the sentiment is pretty positive. And then the other one would be, there's two more, but the other one would be the PMIs, the Purchasing Manufacturer Index, which is another survey out there. This is from State Street, put this out a few days ago, but this shows not only the U.S., which is that bright blue line, which has probably started to peak, to be honest with you, but Europe has done very well, in fact, probably better than expected. And then the one that's out there that's probably maybe struggling a little bit is the emerging markets. And if you'd asked us at the beginning of the year, we thought emerging markets would do well, maybe be a leader, mainly because we thought the dollar would continue to weaken, which was a consensus view. That's not really happened, which I think has created somewhat a headwind there, but we'll talk about that as well. But overall, PMI numbers look very good, well above pandemic levels again. And then consumer net worth is again one of the best leading indicators out there. And they actually had an estimate of 138 trillion. That actually got revised up to 142. We'll get the second quarter. It tends to be a lag, so it's going to be a few weeks before we get that. Actually, probably a month or two. But honestly, if I was on a desert island, I could only get one piece of data. This is probably the one I would get because it's very consistent. It leads the economy by about 2 quarters. So until we start to see this thing roll over, it's probably a good indication the economy will continue to expand. So bottom line, we talk about the same indicators over and over again, but net worth, PMIs, company surveys, claims, if they're all heading the same direction, they tend to point to higher growth, and that's what we're seeing. This is an economic forecast from Evercore. They recently raised their estimates for the second and third quarter. Fourth quarter is about 6% GDP growth, which I think we will see a slowing of the economy, of the growth of the economy, not the economy in general. But the big picture is estimates now are pointing towards about 250. I would say it's a little aggressive, but somewhere between that 230 and 250 range for 2022, which from our standpoint seems doable, and then would indicate there's further upside going forward. The global economy, I'm going to skip this chart, but the global economy is also in a recovery. The IMF predicts growth for 2021, our current year, which we're about halfway through, at about 6%. That's the highest they've seen since 1980. So again, it's not just a domestic story; it's also a global story. And I just put this in there because everybody likes to talk about housing. I've been to a graduation party where someone hasn't pointed out their neighbor's house sold for way more than it should have, and housing prices are crazy. So case in point, the S&P Case-Shiller Index has housing up about 14% year over year. So the downside is if you sell your house at a higher price, you probably have to buy another house at a higher price. So I don't know if they wash out or not, but something we've watched. I think there's a little bit of a constraint as far as supplies go as well with lumber and things. So that number actually could be higher as we go in the next few quarters. So I'll pause there. I'm going to get a drink of water, but if there's any questions at this point.
Actually, there are. With the strength of the dollar, do you plan on changing the foreign stock exposure in the portfolios?
I guess the short answer is no, not at this point. In theory, a weaker dollar tends to help the markets, not only the international equities, but also domestic equities tend to do better because for a lot of reasons with labor overseas and stuff like that. But I guess in the short term, no, the answer is not. You know, I would love to see the dollar slightly weaken in here. That tends to be a good thing for emerging markets, and we tend to have a slight overweight to emerging markets. But I don't see us changing the allocation. I think if we saw a breakout of the dollar where it looks like the trend is changing from a more of a secular trend to a long-term trend of the dollar strengthening, we might want to reconsider our position, which would mean you want to lower it, not increase it. But you know, if I learned anything over the years, the dollar tends to go up and down, but the long-term trend seems to be lower, not higher. So I wouldn't want to be too short-sighted on that. So I guess the answer is not at this time.
Okay. I have something, and kind of an interesting personal story to share. When you talked about unemployment and the shortage of workers, we were at a restaurant waiting in line last week, and they had a sign posted that actually said, "Please be patient with our staff. We are shorthanded. No one wants to work."
Yeah.
So we're seeing over here.
Yeah, and I think that's prevalent everywhere. One of our colleagues, we had a call with a client yesterday who owns a restaurant in Hilton Head, and he was saying they just can't get people to work. So I think it's bad here in Ohio in the heartland, but I'm guessing in the resort towns it's probably really bad. But that's the price to pay, and I'm happy to pay that price if the economy is doing better. So
Absolutely.
I guess. So
absolutely. That's all I've got for now, John.
Okay. All right, great. So we're going to shift here to the market. So again, valuations are high. That hasn't really changed. We still continue to expect multiples to come down. I think if you look at historical averages, it's definitely high. We finished the quarter at a little over 21.5 times forward earnings, so the next 12 months. I tend to. We used to say we thought valuations would contract down to 20 times by the end of the year. I'm not so sure it's going to get that low, but as the economy continues to grow and earnings continue to grow, I think most of the returns are going to be geared towards the growth in earnings, not the expansion of multiples. In fact, I think the multiples will be somewhat of a drag. So totally realize valuations are on the high end of the range. That's not to be that surprising where we're at given the cycle, but I think we'll see them come back towards that 20 times, which is the high end, as you can see in the chart there, the high end of the range within one standard deviation. So not a big concern as of now, but something we watch, and our assumption is we'll see multiples contract as we go into the second half of the year. We have seen some consolidations within the market, not so much in price, but just by participation. We spoke, I guess it was back in April this year, and we were close to 90% of the stocks in the S&P 500, so 400 of them, give or take, or 450 of them were above their 50-day moving average, which is a pretty healthy spot in the market, and returns tend to be positive going forward from that. So we have seen that, but we have seen a contraction. So in this chart, as you can see now, we're down about 40, I think called mid 40s, 44% of the stocks in the S&P above that short-term trend, which is the 50-day moving average. The long-term trend, which is this red line here, the 200-day moving average, is still very firmly positive. So I think some of that's just a rotation within leadership. We're starting to see those mega cap names come back into leadership, and the smaller cap names or the smaller mid cap names start to wane from a performance standpoint. So nothing to be too concerned about. I think you'll see that as markets mature, and we're a little over 1 year into the market expansion, which we think will last a couple more years. But there is momentum behind the market for sure, and history suggests we're probably likely to see further gains going forward. We finished the month of June. It was the 5th month in a row that we saw positive returns, so all 5 months were positive. History would tell you there's about 27 times that's happened. We haven't finished this one, which was the August of 2020. So out of the 26 that have been completed, 25 of the times we saw gains higher 1 year later. So the average is about a little under 13%. I don't know if we'll see 13% over the next 12 months, but it does give you indication that there's some momentum behind the market. And as I like to say, there's a tailwind, not a headwind here going forward. And once momentum in the markets tend to take hold, which is a lot of these charts I show on a quarterly basis, it's tends to lead to further gains. So far that's what we're seeing. I think we'll continue to see the markets grind higher as we get into year end. But one of the reasons we're seeing that is first quarter earnings were really strong, with 88% beating the estimates. We literally just started second quarter earnings on Monday, or actually Tuesday, yesterday. Most of the banks have come out. Earnings have been pretty good. Definitely seen companies beat on expectations. So we'll see if that's going to continue. Eventually, we're going to see a point where analysts raise their estimates too high, and it's a higher bar, and the companies will have a harder time beating that. But that's probably another quarter or two down the road. So we should see a pretty good beat this quarter, the second one, which is just completed, and probably into the third, and then we'll start to see that wane a little bit as we go forward. So just to put that into a picture, here's estimates for the 4 quarters of the year back in January. So looking forward, the fourth quarter is about $45. Now, as of June, which is almost a month ago, a little over a month ago, I should say, we're seeing it now at close to 50. So we started the year thinking $200 in earnings for 2022 was probably about where we'd end up. That's actually looking pretty conservative now. As I mentioned earlier on the slide, I would think somewhere above 225, 230 is probably where we're going to end up. 250 is a little high on that range, but it's not out of the realm of possibility. So, again, earnings look good, and earnings tend to lead the market. So, market momentum is not just the U.S., it's also global. So, there's a lot of moving parts on this chart, but the one I wanted to point out was the percentage of the ACWI, which is the All Country World Index, percentage of those markets that are above their 200-day moving average. And there's about 50 countries or markets within the index. 80% of them are above that 200-day moving average. So the trend is pretty strong, going in not just domestically, like I mentioned earlier, but also globally. There's a few pockets out there that have struggled, but overall, the global markets, much like the U.S., have tended to been pretty good. Credit markets aren't really suggesting any market weakness out there. This is the spread we see between the triple B and the double B. So basically, the lowest investment grade versus what we call high yield or junk. And right now, that we're at cycle lows here. So usually, if you would see a crack in the credit markets, that tends to foreshadow a decline in the equity markets, and we're just not seeing that yet. So credit markets tend to lead equity markets, as they say, and so far they're showing a lot of strength going forward. So if we would see that change, that'd be something that we'd be a little more concerned, but haven't seen that yet. And then as it relates to bonds, I mentioned earlier, they're down year to date through the first 6 months. But if you look at history, and this is an interesting study from BlackRock, we've seen the fourth worst return in the first 5 months. So if you take the first 5, so through the end of May, bonds were down about 2.3% here. But history would tell you when they're down the first 5 months, the last 7 months of the year tend to be positive. Some are more positive than others, but just generally speaking, maybe the worst is in for the fixed income markets. We've seen rates move quite a bit from that peak of 175, 180 down to 125 recently. That's on the back of some pretty high inflation news. So we still think rates will probably grind higher in here, but maybe not as high as some people expect. And again, we could eke out a small positive return over the next 7 months. I'm not sure the overall year will be positive, but could see a little bit better price return from bonds. I'm going to stop there. I'll take a pause. If you have any questions from the clients, or if you have any, Deb, I'm happy to take them.
I do. Okay. You mentioned fixed income investing and interest rates being so low. What is our investment strategy for our fixed income accounts right now, especially new clients coming in? How are we investing?
Yeah, it's been a tough market, to be honest with you, within the fixed income market. Just supply out there and a couple other things. So it's been a struggle. Yields, as everybody knows, are really low. you're getting about 1.4%, 1.35% 10-year treasury, which, you know, over a 10-year period seems pretty low to me, and it's definitely low relative to real returns or yields when you adjust them for inflation. So it's been a tough market. We've been very cautious and thorough when we do invest new dollars. I think, you know, overall theme of what we're looking at is, you know, there's something called duration out there, and the two things that we look at most is duration and then credit quality. So we have been short duration, meaning with the expectation of rising rates, it will shield the principal from declining less than the index. So that's one thing. So we've been in short duration. I don't think that's going to change anytime soon. And then on the other end of that, we've had a little bit more skew towards the credit side of the market versus the government side. So we've been a little bit underweight government and overweight credit. And again, and when I say the credit, and it's corporate bonds and high graded corporate bonds. So not on the junk end side of things, and we've been overweight credit. So I don't think that's going to change anytime soon. I know we have a lot of clients out there that are invested in municipal bonds. If you ever want to get on the call with my colleague Rick D'Amico to talk about it more specifically, you know, he'd be happy to do that, and we can set that up as well.
Okay, good. Well, okay, the market is high right now, and it's at all-time highs. Does it make sense to dollar cost average into a portfolio with a large sum of money or a new account? What are you looking at there?
So I've never been a big proponent of dollar cost averaging, and to be honest with you, there's not really any that I know of, any empirical evidence out there that would suggest that. And I guess it really depends on what the time frame is. You know, when we have new money come in, our general rule, we tell clients we'll have it invested within the first 3 months.
Okay.
But you know, that could be shorter than that. It could be, you know, it really depends where the market's at. I mean, as you mentioned today, the market's at all-time high this morning. But you know, I could go back to, you know, if you look at the last several quarters, in fact, the slide I showed you, the last 5 months in a row, the market's been up every month for the last 5 months. So if you had a dollar cost average anywhere in, you know, for a 5 or 6 month period, you know, I think you're giving up something. I think for people that have a long-term time horizon, I think you want to be invested in the market. And I think, you know, it's the old saying, it's time in the market, not timing the market. So, you know, I don't have a problem with it if it's more of a, hey, I just want to get in the market slow because I'm a little concerned, I'm nervous with where the, you know, either the political environment or economic environment. I totally understand that. That's something we can work with clients to do. But you know, our general rule is somewhere with, you know, within the first 3 months, we'll have it invested. You know, some of that's quicker if the market pulls back. We haven't really seen any pullbacks, as I mentioned earlier, so it's been a little tougher, but usually within the first 3 months. So I guess, you know, the dollar cost averaging, you know, I'm not a big proponent of it, especially if it goes over more than 3 months, if it's 6 months or, you know, 12 months, whatever it might be. But, you know, some of that has to do with just the mentality and of the clients and, you know, where they're at within their risk tolerance. So, you know, we can work with people on those things.
Okay, good to know. That's all I have for now.
Okay, great. So, so our portfolios, we already talked a little bit about this because Deb asked about real estate. So some of this I've already mentioned, but you know, our large cap portfolio is about 38 individual companies in it. We've been skewed on the cyclical side of things, and that remains to be the case. I guess if I had to ask, if the question was asked, I don't foresee us changing that between now and the end of the year. You never know the way the markets move, but our thought process is right now to kind of stay where we're at. So if you look at the top, if you look at that column on the left, starting with materials, consumer discretionary, information technology, industrials, financials are all some way, shape, or form cyclicals, and we've been overweight those. Financials is probably more of a recent thing over the last 3 or 4 months. And then if you look at the bottom two on the left, utilities or consumer staples, we've been underweight, and those are more defensive in nature. So, you know, we've been underweight those for a while, and so far that's worked out to our advantage. Our portfolio has done pretty well so far this year. Through the first half of the year, it's been beating its benchmark. So I don't foresee us making that change anytime soon. But you know, you take what the market gives you, so you never know. did mention before, I think, the mega cap names are reclaiming market leadership. This is the FANG. If everybody listens to Jim Cramer on CNBC, he's the one that coined that. And that's Facebook, Amazon, Netflix, and Google. I'd probably throw in Apple and Microsoft in that group, and that would probably round out 6 of the top 10 names in the S&P. And definitely we've seen it on a equal weighted basis break out here. More importantly, it's been doing better versus the S&P on a relative basis. I think that's somewhat of a rotation of the mega cap names and out of the smaller cap names, which I will touch on in a second here. The trend seems to be leaning towards growth over value. This is growth versus the S&P, and as you can see, going back to 2017, had a really big run up into the bottom, give or take, of last year, maybe a little after the bottom of the market in March. So call it, I wrote this down, through July 2020 through March of 2021, we see a big rally in value stocks, but that's kind of dissipated over the last few months. We'll see how it plays out the rest of the year. I think a lot of that's going to do with the direction of interest rates and how fast, if any, change the Federal Reserve puts out there on their tapering process and raising rates, and or the economy overcooling or overheating. So we're keeping an eye on all those things, but it tends to lean like in my view, that growth may be reasserting its leadership here. I wouldn't bet the farm on that one, but that seems to be the way it looks today. Same thing with large over small caps, kind of the same thing. Small caps started to outperform right at the market bottom, which historically is right on cue. They tend to outperform for about a year after market bottoms, and that's exactly what they did over that time frame. And then since then, we've seen large caps reassert their leadership, which is why I think we're seeing some of those FANG names, our mega cap names, break out here recently. So we talked about the dollar, so I won't belabor the point here. We're keeping a close eye on it, as I mentioned earlier. One of the thoughts we had at the beginning of the year was we thought the dollar would continue to weaken, and at the beginning of the year, it looked like it was. We came down to this support line, and then it bounced back up. Some of that's probably a little bit of flight to quality out there, which is why we saw rates start to come down as variants and things. Some of these countries overseas trip up on some of the things doing with the reopening. People want to tend to put money in safe bets, which would be the dollar and U.S. Treasuries. So some of it's that. So we're keeping a close eye, but it does look like there's been a change in direction on the dollar, which, as we mentioned earlier, has a bigger impact on international markets than they do here domestically. So I got a couple thoughts on what's coming up or what's next, but before we get into that, I will pause and see if there's any questions out there.
I do have a couple. Are you looking at adding any other sectors to the portfolio models or increasing an allocation to an existing sector? I think what they're thinking is, are you thinking of adding commodities or something in the portfolio now?
So I'll start on the asset. Well, we call them asset classes, but everybody has to define them differently. So we would define commodities as an asset class. It's something we've held in the past, haven't held it for several years now, probably going back to past financial crisis. So 09, 2010, somewhere in that area is my guess. But we've looked at adding commodities, but well, if you go back 3 or 4 months ago, inflation was still pretty low. Inflation's picked up, so it's probably something we reconsider. But at this point, I tend to believe the Fed chairman that inflation is somewhat transitory, and that's a hot debate right now, and we'll have probably many more conversations on that over the next few months. In fact, I'm sure the Fed chairman's talking about it today as testimony. But if you believe that it's somewhat transitory and we're probably close to inflation peaking over the next couple months, then probably the easy money in commodities has probably been already made. So, it's something we've passed on. It's a zero-sum game. So if you're going to invest in commodities, you got to take it from somewhere else. I'm probably more comfortable in equities than taking out equities and buying commodities at this point. But again, it's something we're keeping a close eye on. As far as the sectors go, Yeah, I talked a little bit about them. You know, we moved from an underweight to an overweight in financials, mainly because we thought rates would continue to go up towards 2%. That hasn't really worked out like we thought. So companies are reporting great earnings, but not seeing a great bounce off of those. So, you know, I think we're committed to that probably for the next couple months at least, and we'll reevaluate it if rates really start to falter. As far as the cyclical, the defensive, I already mentioned that we're sticking with that one. Probably might see us, you know, trim our tech weightings a little bit, but probably stay to a neutral to overweight there. But that's about it. I think we like where our sector positioning is, so I don't think we're going to make any major changes.
Since you mentioned inflation, the June, as you know, the June numbers for inflation are up over the last year. They actually published 5.4%, which is a 13-year high. How will this affect the stocks and bonds in our portfolio? Should we be worried?
Yeah, well, you know, there's the rumor and there's the news. So I kind of think that the rates moved up on the rumor months ago that inflation was we're gonna see a not a slight, but an uptick, probably a sizable uptick in inflation, which we have seen in the month of May, and then as you mentioned in June. And you know, we had an inflation number of 5.4% came out a couple days ago, and the markets really didn't move at all. In fact, we finished at a new high on Monday, hit a new high this morning, and the Treasury yields moved very little. In fact, I think they're back down to where they were before. So, so far, the threat of inflation or the actualization of inflation coming out hasn't had a big impact on markets. It kind of goes back to my point earlier. If you believe in the Federal Reserve thinking that it's some of a transitory phenomenon, and sometime in the next few months we'll see it peak and then start to go down the other side, then it's probably not that big of an event. If it becomes a structural issue where inflation stays at 4 or 5% for the foreseeable future, then I think it's going to be a different story. One of the reasons we increased our allocation to financials was because we thought rates would move up, and that tends to be a good environment for financials. So that's we have made that. As I mentioned, on the fixed income side, we keeping our duration short, and most likely will between now and the next foreseeable future, which helps us mitigate some of the risk, not all of it, on rising rates. Hoping for a better reinvestment point, at higher rates. So we've done a few of those things. Going forward, how it's going to affect the portfolios remains to be seen. I think if it's a transitory issue, it's probably not going to have a lot of effect on our portfolios. If it's not, we'll see that more as we get into the second half. We get into September, October, and these numbers still are really high, and there's no sign of them coming down. Then I think the markets, will take a much closer view of it. And I think the other thing it'll force the Fed to react quicker in their tapering process, and when they raise rates, which has been a hotly contested topic.
Well, since you brought up the Fed's on the record saying that they have a 2% goal for inflation. What's most likely to happen in our portfolios if a tighter money policy is employed?
Well, I guess the question I have for you, do you know when that's going to happen? Because that's really the big key. I mean, I don't know. The Federal Reserve has said they weren't going to raise rates till I think 2023. They moved what they call their dots up a little bit. So there's some people now think maybe it's the end of 2022. They probably won't start to taper until the beginning of 2022 is kind of the consensus, or sometime in the first half of next year. So, I don't know. I try not to put too much thought into it, Deb.
Okay.
But we'll keep a close eye on those things. And I think a lot of times most of that stuff's already baked into the market.
Yeah. I know some people are commenting in the chat line that with all of this good news, we're going to need some good tax planning.
Yeah. Well, I have a chart on that, or a little bit of that, but we'll talk about that on what's next.
Okay, then I'm done for now.
Okay. All right. Thanks, Deb. Yeah. So I think I think we paint a pretty positive picture, which I think is warranted. Again, I think we're at the beginning of what I think is long-term economic expansion, most likely we probably just anniversaried the first year of the expansion here recently, if it started back in June or July of last year. History would tell you that lasts somewhere between 5 and 10 years, and as I mentioned many times, about 7 or 8 years on average. So we think we're going to see further economic growth going forward, which again leads to that process, which we said is good for corporate earnings, and that tends to be a good backdrop and/or tailwind for equity markets and markets overall. But there are a couple negative things. Now, we did just, Deb mentioned before that this is through May. The number for June came out yesterday, so unfortunately for us, we can't get through compliance that quick. But it's up to 5.4%, so it has continued to rise here. As I put the quote here, Milton Friedman said, inflation is always and everywhere a monetary phenomenon. So we're seeing it. If you go back and take a step back, the 50-year average of the CPI, Consumer Price Index, which is a gauge of inflation, according to JP Morgan, is 3.9%. So that includes the 70s and I guess the early 80s as well. So some of those numbers were inflated then, no pun intended. But so we're keeping a close eye on that. So that's one of the things we think could be a negative in the market. If that becomes structural, it's going to be you have to start looking at things a little differently. So that's one, I would say short or midterm negative. The budget deficit, again, is somewhat out of control. I saw a headline today that the Democrats agreed to a reconciliation package of $3.5 trillion. They already agreed to a bipartisan deal. Republicans and Democrats agreed to a $1.2 trillion infrastructure deal. So, as you can see in this chart, and I've mentioned this a few times, I mentioned it last time when we met, the CBO estimates for the deficit are expanding, and my guess is these out numbers here will be bigger than what they're already anticipating. So something we're keeping a close eye on. I guess the question is, does it matter? And we can have a longer discussion on that. But as of now, with rates as low as they are, I would say it doesn't. Second one is the taxes, which I know Debbie just touched on. I think as far as corporate taxes go, the Biden administration has these are growth in 2022, assuming the taxes go through between now and the end of the year for next year. It's about a 6 or 7% hit on earnings growth. That's assuming the president's 28% proposal goes through on corporate taxes. I know Senator Manchin seems to be the tie-breaking vote, or the vote needed to get that passed, that he's more comfortable with 25%. So that that could be less. It could be a 3 or 4% hit to earnings growth. But again, I don't know if the markets has totally discounted that fact yet or not. So that's something we're definitely keeping an eye on. From a positive standpoint, the second half, I think boost is coming as the benefits roll out. We mentioned this a little bit earlier with staffing issues in local restaurants and things, but as you can see, these are the states that have already ended their extended benefits. I think it all runs out at the end of September, if I'm not mistaken. So, we're going to see more people return to the labor markets, or that's the assumption as these things run out. So maybe that helps alleviate some of those shortages, which in turn should be a positive for more economic growth, because as you mentioned with the restaurant, they are constrained by, the revenues are somewhat constrained by labor. So if they have more labor, hopefully revenues would grow, and that should be a positive going forward. So we'll see if that happens. I doubt there's going to be an extension to that one. Lessons from 2020, I like to kind of beat this drum every quarter, is really just staying invested. And we talked a little about dollar cost averaging, but if you have a 10-year time horizon or longer, which I think most of our clients would, you have about a 95% chance of that rolling 10-year period, and they move forward as you go, being positive. You get up to 15 or 16, and you're almost near 100%. So I think it goes back to that time in the market, not timing the market analysis. And I would say so far, being invested over the last 2 years, even though we had a really big drawdown, has been pretty beneficial. It's been one of 2 better years we've seen in the market. So that's all my comments. I will open it up to any more questions if you have. I know we took a lot as we went through, but if there's any more, I'm happy to take them.
I have one more, and this is like the gold star question because I've been asking you this for the last 2 years and you've been giving me pretty much the same answer. But here
Okay.
it is. With everyone talking about the risk of higher inflation, why do you think gold isn't seeing better performance this year?
Yeah. So the gold star question had to do with gold. So
Right.
I don't really know. I mean, gold is a supply demand issue. There's no yield to it. There's no dividend to it. So it's just hard to gather, what the valuation on gold is. You would assume in certain markets where market periods where inflation goes higher, if gold really truly is a hedge to inflation, it would go higher with that, or at least a move in anticipation. It did move up there a little bit. I know it's moved sideways. It actually broke down to its 200-day moving average. I think it bounced off that, if I'm not mistaken. So I would have anticipated it would have done better, but it's not. And I wish I had an easy answer why that is. It's not something we focus on too much. We don't own gold in portfolios. We have owned it if clients have asked us to buy it for them on a request. We'll do that, but it's not something we see as a long-term asset class within the portfolio. If it's part of a bigger asset class like commodities and has a small portion of gold, I think that's fine. We're not really gold bugs, nor do we recommend buying, physical gold for clients. So your guess is as good as mine on the price action of gold, but I do think it has a, big picture, has more competition than it did. People are buying Bitcoin as a hedge to inflation. Again, I'm not sure that's a good answer to that, but I think if you're a millennial, and those millennials are now starting to come into their own in investing, I think they're much more likely to buy some type of cryptocurrency than buy physical assets. So maybe there's just maybe there's a demographic shift there going on. I don't know.
Well, you've been right for 2 years, so
Well,
congratulations on that.
thank you. Any other questions? If not, I appreciate the time. Appreciate a shout out to the marketing group. I know Annika's on the call and she's been really helpful with us on the slides and compliance and all those things. It's definitely a team effort here at Fairport. So, thank you to everybody involved.
Thanks, John. And for those of you who sent questions in and we were unable to answer them within the time permitted, the investment team and or your advisor will reach out to you directly. And lastly, I want to thank you so much for joining us today. It's our privilege to inspire you and your family, and we are really, truly grateful to have your trust and loyalty. We can't say enough about that. It's so important to us. So stay safe and well until next time, and have a great day. Thank you.
Thank you. Bye-bye, Deb.
Bye-bye.